There's a trap that millions of traders fall into every single day. An indicator that seems like a holy grail, but in reality, it's nothing more than a mirror reflecting the past. RSI, the 70 and 30 levels, won't lead you to profit. They'll lead you straight into the jaws of the sharks. In this video, I will expose the hidden truth about RSI and show you how to escape before it's too late. 1. The RSI 70-30 trap. If one night you see the RSI indicator hitting 70 and you instantly sell, or when it falls below 30, you rush to believe this is the golden moment to catch the bottom. My condolences, you've just walked right into a preset trap, because the moment you buy might be exactly when the sharks are preparing to dump, and the moment you sell could be when they quietly accumulate. RSI, Relative Strength Index, was once hailed as the holy scripture of technical analysis. People whispered a secret to each other. Above 70 means overbought, sell. Below 30 means oversold, buy quickly. Millions of new traders entered the market with that naive belief. As soon as they saw RSI cross the threshold, they entered reversal trades without thinking twice. But then, time began to teach them a bloody lesson. Because there were times when overbought still climbed another 200, even 300 pips, and times when oversold kept plunging thousands of dollars more on the gold chart. And here lies the tragedy. The more you believe in the 70-30 thresholds, the deeper you sink into pain. The market doesn't reverse when you want it to. It only reverses when the crowd has already rushed in the wrong direction, to become a liquidity feast for the massive capital flowing out. 2. RSI, consequence, not a signal. The market never reverses when you want it to. It only turns when the crowd has already rushed in the wrong direction, when every retail trader becomes fresh blood to fuel the big money's escape. This is the deadly blind spot. Millions of traders believe RSI is an objective mirror of the market. But the brutal truth is, RSI only reflects what has already happened. It never foretells what's about to come. When RSI crosses 70, it's merely the result of a strong rally. It doesn't mean price will reverse, and it's certainly not a reason for you to short in haste. Yet the same familiar script plays out. You sell when RSI is high, price keeps climbing, you panic and cut losses, then just a few candles later, the market finally drops. Or you buy when RSI is under 30, price keeps falling, you hold the loss until you can't take it anymore, cut the trade, and that's when the market turns. Once again, you become the liquidity provider, not by accident, but through a preset script repeated endlessly, exploiting the psychology of the crowd. Why do the sharks, the true operators of the market, love it when traders use RSI mechanically? Because its simplicity and popularity have turned RSI into the perfect psychological trap. You think RSI is a technical tool. In reality, it's a tool to manipulate emotions, a sophisticated illusion that makes you believe you've spotted a reversal signal, when in truth, you're jumping in exactly when the sharks need someone to dump on. Picture this, on the gold chart, RSI hits 72. You think it's overbought, time to sell. You take profit, then short. But what you don't see is that while RSI is above 70, volume is still exploding, green candles keep surging. That's not a sign of weakness. It's the footprint of sharks accumulating more, or pushing price higher to ignite FOMO. You sell in fear, while the big money coldly keeps buying. And that's why today I want to expose a truth you may have never heard before. RSI is not a signal, it's a consequence. It doesn't predict, it only reflects what's already passed. And precisely because of that, it so easily becomes a deadly bait, the trap that millions of traders fall into every day. 3. When RSI is trustworthy, divergence now, get ready. Because we're about to dive into 3 truths that, if you still see RSI as the sole key to reversals, this game will crush you. If you understand correctly, just in the next few months, you'll step out of the endless cycle of gains and losses. You will no longer be a gambler betting on the red or green of an indicator. You'll begin to see through the eyes of a true predator, an investor who waits for timing, not a pawn being manipulated. Before touching any tool, remember this. What matters is not how well you memorize its numbers, but whether you understand what it measures, under what circumstances, and where its limits lie. RSI, Relative Strength Index, may be the most popular indicator, but for that very reason, it's also the most misunderstood. It's not a magic mirror to predict the future. it only tells the past. And here's the paradox. Only when you let go of blind faith that the indicator is truth will you finally see this. In reality, there are times when RSI stays above 70, even 80, not for a few minutes, but for many sessions in a row. Because when the trend is strong enough, demand doesn't weaken, it actually keeps rising. RSI is high, but that's only the result, not the cause. It doesn't mean price will reverse. It only means price has surged too fast in a short span. Period. And it's precisely the simplicity of the theory, sell at 70, buy at 30, that has dragged millions of traders into baseless decisions. But the market doesn't run on round numbers. It runs on flows of capital. That's why RSI at 70 can march straight to 90 if big money is still pouring in. RSI at 30 can be forced all the way down to 15 if selling pressure hasn't stopped. If you cling to fixed numbers, you'll become a victim of the rigid framework you believe in. Back to the essence. Price only rises fast when the crowd starts paying attention. When RSI touches 70, retail traders think the price is about to reverse. But that's exactly when sharks appear. They don't look at RSI like you do. They look at volume, they read price structure, they calculate where liquidity lies. Sharks know that if they want to unload at the top, they need buyers. If they want to accumulate at the bottom, they need sellers. Only when the crowd rushes in the opposite way with eagerness do they have enough counterparties to do the reverse. You think RSI is a signal, but to sharks, RSI is just bait, a psychological tool to spark expectations. When RSI climbs past 70, you think price is about to fall and you sell. But at that moment, you're simply providing liquidity for someone else to buy. When RSI drops below 30, you believe price will bounce and you buy. But then you're just handing liquidity to someone else dumping. That's why if you use RSI mechanically, you'll always act too early or too late. You'll always be trapped on the wrong side when the market turns. Not because you didn't see the signal, but because you saw it too soon. And here's the harsh truth. RSI should never be the only reason you place a trade. It cannot exist as a standalone signal. If you want to find the key to unlocking its essence, the answer lies in one thing: divergence. This is the moment when RSI no longer just reflects surface price movement, but begins to reveal inner weakness or strength. Picture this. Price makes a higher high, but RSI makes a lower high. That's a sign buying momentum has weakened. And this warning is far more dangerous than any 70 number. On the flip side, when price makes a lower low, but RSI fails to make a new low, that's the mark of a bullish divergence. Selling pressure has dried up, the downtrend is weakening. This could be the moment that prepares for a reversal. But carve this into your memory. Divergence doesn't happen often, and even when it doesn't guarantee an immediate reversal. If you rely only on divergence without other confirmations, you can still be lured into the next trap. 4. Volume, living evidence. And now, this is when volume steps onto the stage. Volume never lies. It is the living trace, the secret logbook of every move in the market. When RSI shows divergence and volume quietly begins to decline along the trend, that is no longer a vague signal. It is a whisper from the shadows telling you the trend is weakening, big money is preparing to withdraw. But if RSI shows divergence while volume is still surging, be cautious. Because that might just be an illusion, a false divergence, or worse, merely a short pause before the main wave strikes even harder. Volume is the one that exposes the truth RSI cannot hide. 5. RSI in market context. Let me give you an example. On the gold chart, price makes a new high, but RSI fails to keep up. The volume on the green candles begins to dry out, then suddenly, a massive red engulfing candle appears with explosive volume. This is no longer a vague signal. This is a cold alarm bell. Big money is pulling out, the sharks are taking profit. And if you still believe that a breakout high means buy more, then congratulations, you're buying the very assets they're dumping. The reverse scenario is just as dangerous. Bitcoin makes new lows one after another, but RSI no longer plunges lower. The volume on the red candles gradually fades, then suddenly a giant green candle appears, engulfing the previous red candle with enormous volume. That's the footprint of smart money quietly accumulating. If you still believe that RSI under 30 means it will drop further, you'll miss a potential reversal point. Remember this, RSI is not a lens into the future. It's more like a rear-view mirror. You can't drive a car only by the rearview mirror, but you can use it to watch out and prepare. The issue isn't what RSI says, but how you combine it with volume, price behavior, and market structure. Your past failures weren't bad luck. They came from believing in a mechanical formula without understanding what was truly happening behind the scenes. That's why thousands of traders ask the same question. Why do I still lose when I trade exactly by the book? The cold answer is, you're using a tool from the 1980s against a market ruled by robots and algorithms. If you don't change perspective, the very weapon that once worked will turn into the knife stabbing you in the back. So how do you escape? First, change the way you use RSI. Don't treat it as an on-off switch to enter trades, but as a ruler measuring the relative strength of a trend. RSI doesn't promise reversal points. It only tells you how strong the last rally was, how brutal the last decline has been. Second, don't jump in just because of a faint divergence. True divergence is when price makes a new high but RSI fails to follow, or when price makes a new low but RSI holds higher. And most importantly, it must come with weakening volume. At that point, wait for further confirmation. A reversal candle with sudden volume or a false breakout instantly pulled back. Third, always place RSI in the bigger market context. If the market is in distribution, high RSI is normal. If it's in accumulation, low RSI doesn't necessarily mean a bottom. Only when you understand which phase the market is in, accumulation, markup, distribution, or markdown, can RSI truly become a useful tool to reveal underlying strength. And finally, never treat the 70-30 levels as absolute truth. Some currency pairs can push RSI to 80 or even 90 without reversing. Some markets keep RSI hovering in the 50-70 range, never touching 30. If you apply the same formula to every chart, you've fallen into the trap of false uniformity. 6. The final lesson. Never forget, the market does not run on neat round numbers. In this place, any indicator applied blindly becomes a deadly trap. RSI, if understood correctly, is only a supporting tool. It can hint at anomalies, but the final decision must always rest on the bigger picture: price action, market structure, money flow, and timing. No single indicator, not even RSI, is ever enough to risk real money. If you watch long enough, you'll notice a cold truth. Explosive rallies often begin when RSI has just crossed above 50. Deep plunges often start when RSI has just slipped below 60. That means if you wait for RSI to hit exactly 30 before you dare to buy, you may already have missed an entire wave that started earlier. So what's the right way to use RSI? Not as a button for an instant buy or sell order, but as a mirror reflecting the exhaustion of a trend, as a warning when divergence comes with abnormal volume, as a sign needing further confirmation, not a green light to charge in. An RSI understood correctly becomes a sharp blade, exposing what the crowd doesn't see, that behind every price wave lies a hidden current of psychology, and only those who wait patiently can step in at the true moment of market shift. Not because RSI said so, but because all signals align. Losing traders often blame indicators. But the truth is, the one who made you lose was the way you used it. RSI is neither useless nor holy. It's just the tip of the iceberg. The hidden part matters more: money flows, crowd behavior, and the larger market structure. The market never gives you certainty. It only lets you survive if you accept probabilities. In the world of probabilities, RSI is just a secondary signal. It may hint at imbalance, but it never guarantees results. If you wield RSI like a blind man's cane, you'll always be led into dead ends, where every wrong reversal tears another wound into your account. The greatest lesson today: RSI is just one piece of the puzzle, and only when you see the whole picture can you escape the blindness of the crowd. You may ask, if RSI is so easily exploited, why is it still so popular? Because the most popular things are always the easiest to exploit. Sharks know everyone studies from the same book, with the same 70 and 30 levels, and that is the perfect bait for psychological manipulation. Think back. How many times did you sell when RSI crossed 70, only for price to keep climbing? How many times did you buy when RSI fell under 30, only for price to keep dropping? The fault isn't in RSI. The fault is in your belief that it was an absolute signal. You forgot that the market is only a game of probabilities and money flow. If you want to escape this cycle, you must abandon the fantasy of a holy grail indicator. Instead, learn to observe, learn patience, learn to connect scattered signals into a system of understanding. Ask, why is price still rising while RSI is high? Why is price not bouncing when RSI is low? And in that blind spot ignored by the crowd, you'll see what others never will. The market doesn't pay those who know the most indicators. It pays those who understand what's really happening beneath the glossy surface of signals. And that person doesn't need to be a genius, only someone who doubts, who waits, who stays silent until confirmation comes. The final principle to carry into every trading session: never act because of one indicator. Act when there is consensus. When RSI diverges, when price action aligns, when volume confirms, when everything matches, then you place your bet with the highest probability. The market will always have noise, false breakouts to deceive you. But if you have a clear, tested method, you won't fear those 70s or 30s anymore. You'll know when it's a trap, when it's real, and when to stand aside and wait. That is the line between someone trading with emotion and someone trading with analytical thought. If RSI has ever disappointed you, then today, forgive it. The fault was never in the indicator, but in your expectation that it would do something it was never designed to do. RSI doesn't promise reversals, it only tells a story, how fast the market has been running. The road ahead you must write yourself through observation, analysis, and patience. And if you want RSI to become a truly effective weapon, never use it alone. Place it beside volume, price structure, and money flow. When you do that, you'll no longer see the market through a narrow slit, but with the eyes of someone who truly understands the game. Then, you'll no longer be haunted by the numbers 70 or 30. You'll walk with steadier steps, trade by trade, through the dark and treacherous night of the market.